Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Wednesday, September 2nd, 2020. And here are our top stories: private markets in 401k, DC plans, and dispelling some myths and offering clarity around private markets. Joining me now to discuss this and more is President and founder of Decolta, John Epstein, and the Chief Executive Officer of Voya Financial's Retirement Division, where he's also a board member of Decolta, Charlie Nelson. Gentlemen, thanks so much for joining us on the program this morning.
It's great to be here. Thank you.
Yeah, thanks for having us.
Yeah, it's great to see you. And I really want to dive into this topic of private equity and alternatives. But John, I want to come to you first because I want to learn a little bit more about who Decolta is and who its members, what the members that comprise the organization.
Yeah, sure. So Decolta, we were created back in 2015 as a nonprofit organization to not only enhance but secure participant retirement outcomes through education, research, as well as advocacy on the benefits of including different types of alternative investments like private equity within a defined contribution framework. I don't know if your viewers know exactly what defined contribution plans are, but these typically include, your 401k plans, your 457 plans, as well as 403b plans. As far as our membership, really diverse. We serve as a collective voice for not only the DC industry, but also the alts industry. We're comprised of plan sponsors, plan consultants, record keepers, indice firms, as well as others that support our mission.
Yeah, absolutely. And Charlie, you're a member of the board, but you also represent one of the largest United States record keepers. You oversee plans that are 403Bs, 401Ks, governmental 457s. First, I want to get your perspective about Decolta, and then we can kind of talk a little bit more about alternative investments. Why don't you give us your perspective about Decolta?
Well, it's important. It's an important organization because we all need to be advocating for increased access and inclusion to the investment markets. This is going to drive improved outcomes for both the plan and participants, that they have greater investment opportunities to invest in. And I think it's important to kind of demystify a little bit of this as well, in terms of kind of what we're advocating for as a record keeper DC provider and what we're not. We're not advocating for inappropriate, high risk, high volatile, highly volatile types of investments. Alternatives, and what the association is about, is there's a wide range of alternatives. And what we're advocating for is increased access to those appropriate investment vehicles for long-term retirement investors. And there's a wide range of alternatives which have very strong risk-adjusted returns, net of expenses, which may be appropriate for inclusion in a well-managed, diversified multi-asset fund. And that's why we're leaning in and working with Decolta to improve the access to alternatives.
Thanks, Charlie. And Charlie, I mean, your organization, you're working with, as I mentioned, different types of defined contribution plans, 401k, 403b. You're also working with many investment advisors, consultants, and also asset managers. In your talks with, your organization's talks with plan sponsors, is this an increasing area of interest for them? Many of them have pension plans that may use some of these investments. So is this something that you're hearing more and more in some of those conversations?
We are hearing more and more, yes. And, it does vary by plan size and type. As you point out, Jeff, access and inclusion of alternatives in defined benefit investment management has been around for a long time, and many large defined benefit plans may invest in various types of alternatives. In the defined contribution area, it is not as widely utilized. And that's an area where we're trying to create the conversation and awareness. Interestingly, both plan sponsors and even some advisors, consultants are not necessarily aware of the wide range of alternatives that are available to them and could potentially benefit participants. This is something that we're trying to create awareness for. Mm-hmm. And it's just like, a couple of key reasons as to why it's important to do this. If you look over the past 20 years, we have roughly 50% less public companies than we did 20 years ago. So that means the companies that are retirement plans that 401k investors or 403b or 457 are invested in is roughly about half the size of the universe that it was 20 years ago. And, we've seen at the same time a very significant growth in the wealth being created in the private markets as more and more companies have gone private, and you've had to have special access to those markets. So, in short, we think individuals are in fact receiving increasingly less choice and opportunity when it comes to investment options to grow their long-term retirement savings. And we're trying to create greater awareness of that with the plan sponsor and advisor consultant community.
Yeah, thanks. John, I want to follow up on Charlie's comment about the smaller number of public companies. I know you and the organization have done quite a bit of research and have access to research across the industry. Any thoughts about what Charlie just mentioned?
No, it's pretty prevalent. There was a recent study actually that came out last week that I was reading from Syracuse University that really delved into that public market number and figure, and there was about a 60% decline over the last 20 years in the pool of micro cap stocks. So these are stocks that have a capitalization under 250 million, and this is really an important pool that average investors need to have access to that clearly is not being represented in the public markets today, that we need to see available to average investors through better access within 401k plans. And that's what we're advocating for.
And I think, John, I want to come back to you on this, but I think what I heard Charlie mention and what I hear you clearly mentioning is that it's a lot around education. And when you're a fiduciary, you're a plan sponsor, you're sitting in that chair, you're representing the participants, the beneficiaries of a retirement plan. You have a fiduciary duty to explore all different options to make sure that your plan is built appropriately. And through that, you need education. Would you agree with that? And that's one of the purposes of the organization, to provide research and content on a regular basis.
Clearly, we agree. We were so the recent Department of Labor information letter that was issued in early June 3rd, is something that we're not only supportive of as an organization, but we were clearly instrumental in as far as its issuance. We met with the Department of Labor. We outlined a fiduciary framework. So these are items that plan sponsors should consider when evaluating private market investments like private equity. And as an organization, we have a committee that's focused on issuing summary briefs on all of the items that are really outlined in the letter itself, such as valuation and pricing and liquidity, fees and expenses, as well as how to measure investment performance, how to benchmark these types of investments, and risk and attribution. So we're definitely focused. We've been doing this for 5 years, so we're clearly geared up to educate not only the DC community but also bridge the alts investment community into this.
Yeah, absolutely. Well, gentlemen, I want to go to a quick break. When we come back, we're going to talk more with John and Charlie about the fiduciary framework, maybe try to dispel some of the myths, and hey, look, learn a lot more about alternatives. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
If you were like 58% of Americans, you didn't go to college. Or you did, but never finished. Maybe it's the thought of a big, intimidating campus. At Independence University, all classes are held online. Maybe it's the thought of being alone in a sea of students. At Independence U, you'll get a personal support team to help you every step of the way. Maybe it's the cost of all those books and supplies. Online means no books to buy. We even give you a new laptop and tablet to keep when you graduate. Maybe your life doesn't fit typical college classes. At Independence U, our online college fits your schedule. Let's meet a few students.
Independence University held my hand through the process.
Don't be afraid to take the leap because it has changed my life drastically.
Just take the first step and you can do it. If I did it, you can do it too.
At IU, there's no barriers to your degree.
800-535-9916.
Welcome back. We're talking to John Epstein of Deculta and Charlie Nelson of Voya Financial. Gentlemen, thanks for staying with us this morning.
Great to be here.
Well, I really appreciate the education. I know I'm learning a lot this morning. Charlie, I want to come to you because last segment you mentioned there are myths. And I think we also talked at length about education. What are some of those myths that kind of need to be busted, broken down?
Well, I think one of the myths is that people think of private equity, or that when they hear the term alternatives, they think of high risk IPOs. Oh boy, you're just investing in companies that are just going public, and isn't that high risk, or more risk than a retirement investor should invest in? And there are a wide range of asset classes and types of alternatives, some of which are IPOs, but that's and initial offerings and other types. But that's not necessarily what we're referring to here. What we're referring to in alternatives are appropriate asset classes that, depending on what the manager or the fiduciaries, I should say, are wanting to include, may provide broader diversification than they could otherwise be able to receive, because you have a better or a wider investment opportunity or set to evaluate. The second myth I would point out is around liquidity. And people say, "Oh, geez, don't you have to tie these up for a quarter, a year, and we have to be daily valued in a DC plan?" And while what I think how they're being currently utilized and how they could be utilized, at least initially, are in a well-diversified multi-manager target date or risk-based fund. You could take a portion, a small percentage or a percentage of some sort, into alternatives and include it in there. And so you can deal with part of the liquidity or valuation time period for those, just in terms of the size of the plan and the percentage that you invest in. So it's not necessarily a single fund into itself, obviously. But when you think about that, also think back about participant investors. Just what we've been experiencing in COVID since March. We still have seen within Voya 95% of participants not make an investment trade, go from Fund A to Fund B during this time period. So 95% of participants are holding firm in their funds in a pretty highly volatile market and equity time. And if you're thinking of long-term investors, this really fits quite nicely for long-term investors that have a portion of their assets that, they may not necessarily need daily valuation to be able to go in and out of the market because they're not doing that anyway. Certainly, as you get closer to retirement and those retirement where you're drawing down your account, you may want to have more liquidity. But it doesn't necessarily equate to alternatives of private equity to illiquid investments. You got to think of it more broadly than that.
Yeah, thank you, Charlie, for that. And John, I want to come back to you because there are plans today. There are DC plans today that are using alternatives. They tend to be on the larger side, but they also have them in their pension plan. And so there are members in a pension plan, in a public pension plan, for example, that are getting the benefit of these private market investments, alternative investments, but on their DC plan, they're not. And in my mind, there's a bit of a disconnect there.
Exactly. I think the DOL and the SEC, are doing this in a methodical way where they're trying to level the playing field. And really what that playing field is the pool of alternative investments or private markets, which is the topic of the DOL letter itself. And what we have seen as an organization, we've conducted our own research in collaboration with the Institute for Private Capital, which is out of UNC Chapel Hill, to really look at what an average investor, how they would have fared if they invested in private markets within a multi-asset framework or a diversified portfolio. And the myths that you were referring to before are clearly dispelled by our results. And we saw that an allocation to private markets clearly enhanced performance of the overall portfolio. We also saw that volatility was clearly minimized when you include an allocation to private markets. And where we were surprised is the diversification benefits. So when we look at risk-adjusted returns, the portfolios that include some type of allocation to private markets clearly did better than those that did not. And also you have to take into account another myth, which is high cost. So when you typically hear private equity or hedge funds, people assume that these are high cost investments, and our results and study were done net of fees. So all of these things and all of these myths that we're hearing in the marketplace from, whether it's plan sponsors or advisors, they can take a look at our study as well as some of the other studies in the industry that have been done, and it clearly supports the investment merit for private markets and DC plans.
Thanks, John. Charlie, one thing I left out in your introduction is that Voya is also an asset manager. And I want to get your perspective as an asset manager offering a set of target date funds. Would you expect, and there must be 40 or 50 different flavors of target date funds that are out there, but would you expect asset managers such as yourselves or others to explore, now that we had this letter ruling from the Department of Labor, to explore the inclusion of alternatives in some of these off-the-shelf products, or the creation of another tranche of a type of target date fund that includes this type of investment?
In short, yes. I do expect increased activity by asset managers to have and to include various types of alternatives at some percentage in either their risk-based, multi-asset class, multi-manager type risk-based target date type funds as we go forward. Absolutely.
John, just coming back to you, your membership is very broad. You have consultants, you have people like Charlie on the record keeping side, you have asset managers clearly. In terms of the outreach, how do you continue to get the word out? You do great research at the Culta. Is it just continuing to do articles, to do thought leadership, to do speaking events? I know that you spoke at the Defined Contribution Institutional Investment Association Summer Series. That's a big word to get out. But what are some of the things that you're thinking out as a group to get this information out more broadly?
Yeah, so as an organization and strategically, I think the summary briefs that we're going to be releasing on each of the topics, again, that are outlined in the fiduciary framework as part of the DOL letter, is one way to get education out to the whole community. And I think others, when we hold our annual as well as our quarterly meetings, these are times when folks can either dial in or attend in person. This is pre-COVID, of course, where they can listen to really all different topics. So not only investment merits of alts, but also the implementation, the operation aspects of including these private markets in DC plans, and it's ongoing. So this is something where the DOL letter is certainly a great thing to happen, but now the real work is starting, and like Charlie mentioned, and we're clearly gearing up to educate both the alts industry and DC industry on how to accomplish this.
Yeah, and I will say for this network, we are definitely interested in learning as much as we can. We want to educate viewers, and in a few weeks, we're going to have on 2 alternatives consultants to talk about a little bit more detail. I think we need that. Well, gentlemen, I'm going to leave it there. John Epstein, Charlie Nelson, thank you so much for making time. Thank you for breaking this down for us, and we look forward to having you and others on the program again very soon.
Thank you very much.
Thanks, John. Thanks, Charlie. Thanks for sharing your perspective. And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.